Imagine two stocks. One pays you 7% a year, right now. The other pays you barely 3%. Which one makes you richer in 20 years? Most people pick wrong. And it costs them a fortune. I've watched investors fall into this trap for 50 years. They see a fat yield, they feel safe, and they buy. Then, the dividend gets cut. The stock falls. And the income they were counting on just vanishes. So today, we settle this. Yield versus growth, what actually builds wealth? And the third lesson is the one income investors get completely wrong. Here's the thing nobody explains. Dividend yield is just the annual dividend divided by the price. A stock at $50 paying $2 a year? That's a 4% yield. Simple. But here's the trap. Yield rises when the price falls. So a sky-high yield often isn't a gift, it's a warning. The market is telling you something's broken. Take AT&T. For years it was the darling of income investors, a yield near 7%. People loved it. Then in 2022, AT&T cut its dividend by roughly half. The income people relied on? Gone overnight. That's a yield trap. And it's everywhere. So a big yield feels safe. But sometimes, it's the most dangerous number on the page. Now let's flip it. A growing dividend starts small, but it doesn't stay small. Think about your yield on cost. That's the dividend you receive measured against what you originally paid. And when a company raises its payout year after year, that number explodes. The greatest example in history? Warren Buffett and Coca-Cola. Berkshire bought about $1.3 billion of Coke between 1988 and 1994. The yield back then looked ordinary. But Coca-Cola kept raising its dividend every single year. Today Berkshire collects over $700 million in dividends from that position annually. On the original cost, that's a yield on cost north of 50%. Buffett gets back more than half his entire investment every year, just in dividends. That's the power of growth. It doesn't shout. It compounds. And here's where it gets really interesting. Let me show you the trade-off in numbers. Picture two $10,000 investments held for 20 years. Stock A pays a flat 7% high yield, no growth. Stock B pays 3% today, but grows that dividend 8% a year. In year 1, Stock A pays you $700. Stock B pays just $300. A wins early. But by year 12, Stock B's payout passes Stock A. And by year 20? Stock B is paying far more every year, and likely the share price climbed too. Growth caught up, then ran away. This is the part income investors get wrong. They optimize for today's check. But a dividend that grows protects you from inflation too. A flat 7% loses purchasing power every year. A rising dividend outruns it. So how do you avoid the trap? Look under the hood. First, the payout ratio. That's the share of earnings paid out as dividends. If a company pays out more than it earns, that dividend is living on borrowed time. Second, look at the track record. The dividend kings are companies that have raised payouts for more than 50 straight years. Coca-Cola, Johnson & Johnson, Procter & Gamble. That consistency isn't luck. It's a durable business with a real moat. Third, and this is the big one, growth beats yield only when the business is genuinely healthy. A growing dividend backed by growing earnings is a green light. A high yield backed by falling earnings? Run. Remember, you're not buying a yield. You're buying a business. Here's the one principle to carry with you. A high yield pays you the most today. A growing dividend pays you the most over a lifetime. The fat yield is the voting machine, loud, emotional, often a trap. The growing dividend is the weighing machine, quiet, patient, and far more powerful. Don't reach for income. Reach for a business that can pay you more every year for decades. So here's my question for you. Would you rather have 7% today, or 3% that doubles over time? Tell me in the comments, I read them. And remember, this is educational content, not financial advice. Always do your own research. If this changed how you think about dividends, hit subscribe. Tomorrow, we're breaking down the 1 ratio Benjamin Graham used to spot bargains before anyone else.